Hi, everybody. It's Jono here with our May investment market summary. And just to bring up to speed on how portfolios are doing and the things that we think were pertinent in the last month. In most of the last 4 or 5 weeks, the news flow from an investment standpoint has been encouraging. The ASX 200 is broadly up about 4% or thereabouts. Most markets are grinding higher. The best continues to be very much the US market, where the stimulus has been really significant, and US technology names, certainly in the very interim, have managed to sail through the pandemic with very little impact on their business, and arguably even have been augmented perhaps by the shift online. I would deem the current situation anyway to be an eerie sort of twilight, and one that's good for asset prices and perhaps a little bit better than I'd anticipated, certainly. The overwhelming consensus continues to be a cautious one, and often when consensus is positioned in a certain way, markets have a happy habit of going against them. And so we have seen a grind higher, and I would deem it a twilight because I guess, from a corporate standpoint, there's been very little that companies have been able to tell us about the impact on their business, given that the pandemic only really kicked in March, which is the last month of the quarter. We've had very significant government stimulus, which has been a great thing across the world, certainly here in Australia with JobKeeper, but also in the US, even more significantly, not just the Federal Reserve's support of asset markets, but particularly to the Paycheck Protection Program, and the doubling effectively of unemployment insurance in the United States has also, I think, managed to hold the wolf from the door in terms of US consumption in the very, very near term as well. And so on account of that, you would argue, or I would argue anyway, that there's this twilight where we're not really getting the true impact on the wider economy coming through, and we might not be able to get a true sense of the economic damage inflicted until such time as these programs end. And so in Australia, it's the end of September. In the US, it's a little sooner. It's the 31st of July. So in that vacuum of news flow, and with the world arguably positioned cautiously, there's been a healthy sort of ballast provided to capital markets that have seen asset prices bounce back. That's the way I would reconcile it. Our view continues to be a cautious one, and we've tried to take advantage of the better asset markets to change the compositions of portfolios to one of resilience, and this is something we've talked about a lot. We really do think that indeed, as we're opening up the economy here in Australia and around the world, which is a great thing, that the return to normality will take a lot longer than people expect until such time as we do get a vaccine. And so we continue to refer as a theme within the portfolios to this idea of the 90% economy, which is that, at best we'll return to 90% of what we had before, because structurally there will be such an impact on certain industries and the way that we go about our lives that it's impossible to get back to 100% of what we were before. And for that reason, equity returns are likely to be diminished in an environment like that. So a bit of an update for everyone on the things that we've seen in the last month or so. I mean, it's almost irrelevant going through the economic data because so much has been made of it, and it really has been carnage. But maybe two things that stand out from our standpoint: obviously the unemployment and underemployment numbers, when taken together here in Australia in April, came in higher than the worst number that we saw back in the 1980s recession. Just shy of 20% of the workforce, as I say, unemployed or underemployed, which is pretty devastating from an economic standpoint, and it certainly doesn't augur particularly well for wage growth over the next 12 or 18 months, which is a concern. Building approvals here too, already very much under pressure going into the pandemic, are likely to come under further pressure with immigration numbers scaled back. That'll have a big impact on new household construction, but equally too, just the impact it's having on younger demographics and the job losses that have been disproportionately born there. That'll have a big impact on new home buyers as well. So it's very possible that building approvals on an annualized basis, I think in the back half of this year, could be down 25-30% annualized. Fletcher Building, one of the bigger construction players in the country, this week talking about a 15% impact on building approvals, broadly speaking, at the residential side. Similarly so on commercial construction, and around about 10% impact on infrastructure. Again, you've got to remember, guys, building and construction, broadly speaking, is 10 or 11% of the economy. And when you add that up with the retail and accommodation services and food services, you're looking at almost a quarter of the workforce in these 3 or 4 sectors. So again, some issues that post the impact of JobKeeper, maybe towards the back end of Q3, we might start seeing playing out in the numbers. From a global standpoint, the big focus on the epidemic now is turned to emerging markets. So Brazil, Russia, and India seeing a real spike in infection rates, which is slightly concerning. In the United States, we're yet to see any impact of a second wave coming through, but maybe we're a week or two early on that. I think that June will be a very telling month in the US as to how they handle the reopening. There are still well over a dozen states operating with intensive care units well over 70% filled currently. So I do think that is a major risk, that potentially we see further lockdowns re-established in the United States through June and July. And as I say, here in Australia, I think we've done a terrific job, really encouraged by the situation, but it will be a slow grind back. Other quick things just to fill you in terms of the portfolio and resilience. So on the Aussie equity side, a couple of new names have turned up in the portfolio we really like. So Coles Myer being one. InvoCare, the funeral operator, is a business that's really been sold quite hard by the limitation on the number of people that can attend a funeral in the very near term. But it's a very steady business that I think that will slowly get back to normal, and is now trading on a 5-year at its cheapest level against the market, and indeed against its own valuations over a 5-year period. Great medium-term story. Spark Infrastructure is another name we've talked about, and these complement the certainty of earnings out of a couple of the tech names that we really quite like as well. So the software player Altium and data center operator NextDC. The other thing that we would say too is that we've tried to, again, ensure that we're not caught out by a rising Australian dollar. The RBA has done a great job of trying to protect where best they can lending in the country. And so they have provided stimulus, but it's just a drop in the ocean compared to what's going on in the rest of the world. And so that relative difference is playing out in the Australian dollar, which is slowly creeping higher. Equally to China coming back with demand for our commodity materials has also seen a record trade balance last month. So the Australian dollar's had a really big impact on portfolio returns in the last 5 years by way of the international equity component. Effectively, annualized returns have almost doubled on account of the weakening in the Aussie dollar over the last 5 years. And as I say, I think we've seen a low point in the currency, so we're trying to mitigate against that. So we've hedged a little bit there. And again, on the Australian equity portfolio, we've tried to make sure that we don't have too much of an exposure to a rising Australian dollar. That's it. I hope you're all well, and I hope you're getting a little bit more freedom back. And until next month, have a good one. Thanks.